Imagine buying a banana for $1 today, and tomorrow someone offers you $10 for the same banana. You don't eat it. You don't question it. You just think, what if it becomes $20? That simple thought creates a financial bubble. Backhand index pointing right. And if you enjoy learning finance and simple stories like this, hit the like button and subscribe now, because this banana story might save your money one day. In a normal world, bananas have real value. People buy bananas because they are food. They are useful. They solve a real need. At $1 per banana, everything makes sense. This is a healthy market. Now everyone wants bananas. Not to eat, but to sell later. People invest savings. Some even take loans. Prices hit $10, $20, $50. Nobody asks, is a banana really worth this much? Balloon, this is the bubble phase. One simple question destroys everything. Why is this banana $50? People start selling. Prices fall. Panic spreads. $50, $30, $10, $2. Collision bubble burst. The banana didn't change. Only people's expectations did. A financial bubble happens when prices rise fast because of hype, not real value. People buy only to sell higher. Bubbles are driven by greed, fear, crowd behavior. And every bubble in history has one ending, chart decreasing it bursts. In real life, bananas were .com stocks, real estate, crypto and NFTs, meme stocks, different assets. Same banana story. Before you invest, ask yourself, am I buying this because it has real value? Or because I hope someone else will pay more? If it's the second one, be careful. You might be holding a very expensive banana. If you buy it only to sell it higher, it's not an investment. It's a bubble. Banana chart decreasing. Like and subscribe. Learn finance the simple way.